I'm excited to be here, sir. Welcome to the podcast.
Thank you. There's no asset which is so good that it becomes a bad investment bought at too high a price. That's really powerful.
So, how do you feel about missed opportunities?
Every day is a fresh day. Every day is a fresh day. Right? So you go into work, it's a fresh day, fresh opportunity for you to assess that stock. Rather, which I tend to go back to all the time is The Most Important Thing by Howard Marks.
I wanted to host Mr. Hari Shyamsundar, VP and Institutional Portfolio Manager at Franklin Templeton. Mr. Hari has had key roles at Franklin, including Senior Research Analyst and Co-Portfolio Manager. Also, he was serving as CEO of Navi AMC.
With your extensive background in the industry over around 2 decades, how has it shaped your approach towards investing, and what do you think is your biggest learning from the markets over these 2 years from these prestigious organizations?
So stocks, we look at them on a day-to-day basis and we see numbers flying around on the screens, on whether it's a computer screen, whether it's on the TV screens. And we tend to view it as, kya ye stock chalega, will it go up, will it, we just tend to reduce them into numbers. But my career has been a bit atypical. I was in the oil and gas industry before joining the fund management industry. And that has shaped my outlook to looking at companies. So I was a part of BG Group, which is now a part of Shell. And BG Group used to own Gujarat Gas, where I had a stint selling natural gas. That, along with my stint as a CEO of Navi AMC, drilled home a point that these are not just numbers on a screen. These are live organizations. These are businesses. These have a lot more behind it than just the numbers which are published. To understand businesses, to understand the stocks, you have to understand the entire organizations. You have to understand the management which is there. You need to understand the organizational motives, incentives, the mood, how motivated the entire organizations are to delivering whatever targets they might have put out. You tend to look at stocks. You can tend to look at stocks and just pin them to what a management has said in terms of their vision. But to execute that vision, you need an organization. No stock is a one-man or one-person kind of a phenomenon. It is backed by a team. It is backed by organizations, and you need to understand the teams behind the businesses and the teams behind the stocks to understand where these stocks are going. So I think that has been something which my experience has really brought home to the fund management approach as well.
So what do you think is the biggest learning in the sense when it comes to investing, any particular strategies that you've adopted from other firms or other fund managers? Is there any particular biggest learning, if you can ask?
From the fund book rather, which I tend to go back to all the time, is The Most Important Thing by Howard Marks. It's a classic. It's a book which I try to read every year. His memos, as soon as they come out, I print them out. Very often with a pencil, I'll be making notes on them. And so many of his observations are very powerful. For example, his quote and his observation that there's no investment which is so good that there's no asset which is so good that it becomes a bad investment bought at too high a price. That's really powerful, and you always have to keep on reminding yourself of that in any market scenario. So similarly, his observations on risk and risk management are stellar. They are always brought to life. For example, the way he explains the notion that higher risk means higher return. I'm sure you have heard many people say this, that certain stock or certain asset class is higher risk, so therefore higher returns. But the way he articulates it is that no, it is higher risks means a higher variability of outcomes. Right? So you can have higher returns, but you can have far worse outcomes as well. On average, you expect to be compensated for that higher level of volatility, so you have a higher expected return. But that is very different from saying that higher risk means higher returns. He has also written another book on mastering cycles, market cycles, and his observation there that cycles eventually prevail. There's nothing which is so harmful to investment health than just extrapolating current trends into the future in perpetuity. There's a lot to be reflected on that, in any market scenario, and even today. So he's had a great influence on the way I viewed it, and that book was my light bulb moment when I was getting into investing.
Okay, great. So let me get on to some current affairs. So looking at the election results and the weak majority, what do you think is in store for us for the upcoming tenure, upcoming years?
So the Indian stock markets have been on very, very strong fundamentals. The fundamentals have seldom looked as good as they are today. Eventually markets are slaves to earnings. Corporate earnings have been coming through in the last 3 to 4 years in particular. You've seen the pace of earnings growth in high double digits, and that has been the bedrock on which this market rally has been built. If you step back a bit more, and irrespective of what the election outcome could have been, the Indian economy in the last 10 years have taken certain steps which cannot be denied. Those measures, like, for example, the Insolvency and Bankruptcy Code, or the enactment of GST, or RERA, which is being put in place, and the cleaning up of the corporate balance sheets and the banks' balance sheets, are measures which cannot be taken away. The history of Indian elections has shown that successive governments have always built upon past governments' initiatives. That was true in 2014, and irrespective of market or election results in 2024, that continuity should be expected of the Indian economy. So the Indian economy and the Indian story is a longer term story than just an immediate story. We are therefore in a position where we are at the start of a multi-year investment cycle.
Okay.
This has been definitely propelled by the government's sharp pickup in expenditure, in capital expenditure, moving from a base of about 3 lakh crores a year to now about 11 lakh crores a year in a very short period of time, in a period of maybe about 4 years. At the same time, we are seeing signs of corporate capex picking up as well. We are seeing real estate showing ample signs of life. It's reflected in the stock prices as well of some of the developers, but on the ground we are seeing inventories at all-time lows in terms of the amount of household which is outstanding to the sales rate today. The only bit which has been a bit weak is consumption. That's well choreographed, well telegraphed. Even within that, we are seeing a theme playing out. We are seeing premiumization picking up, and the premium segments of the economy are doing well. It has been attributed to a K-shaped nature of recovery, but we believe that the upper leg of that K is a theme in itself. The premiumization theme is here to stay. Over the next decade, you will see that continuing to gain momentum and continuing to do well. So in aggregate, I think that the Indian stock markets are on solid fundamentals. We continue to expect to see the corporate earnings playing out in the coming years and continue to be healthy.
So can I put it in this way, that irrespective of whichever government that comes into power, Indian economy is going to stay strong and is going to grow on a larger scale?
Different governments will have different priorities. The lever which they have to play with is the spend and the way they look to spend. In recent times, we have seen the quality of expenditure improving in the sense that it has been skewed towards capex. Now, capex is essential for the long-term growth and productivity and improving the productivity of the economy. That means that this spend, whether it can be tweaked by another government, definitely it can happen. And even the electoral verdict which has been delivered right now could result in some tweaks in the way the government is looking to make expenditures. I think the early signs are also pointing towards that. We can see some adjustments to the way the expenditures are being made, but The story is so good that it is on a firm footing nevertheless.
Okay, got it. So I want to understand, how do you evaluate a business model, understand and stick to that particular company or a firm, even though there are a lot of fluctuations in the market, there's a lot of volatility. How do you stick on to that one particular firm? How do you build conviction to that one firm, or do you take calls on a quick basis? How do you evaluate a business model is my overall question.
Sure. So we look at, so to start off by looking at a business model, you have to understand the industry context in which the business is working. So industry analysis is paramount. Within that, what's important to analyze and understand is the customer need which is being met. You can tend to analyze a firm very narrowly, and if you do that, you can tend to wildly overstate the prospect. The classic example of that is, if in the early 1900s you were looking at buggy whip manufacturers, horse buggy whip manufacturers, and they defined, or just buggy manufacturers, horse wagon manufacturers, you'd have said that, well, there are so many horses this can grow, there's so many opportunities which are there for this particular business to grow. But the underlying need was of transportation. Okay. So when the motor cars came along, this business model became obsolete rather. So the industry context definitely is important to look at, but understanding the underlying consumer need is possibly even more important, because that will pin then substitutability, where the competition come from, not just to the particular company, but to the industry as a whole. You have to therefore start off at that particular point, understanding customer need, understanding the industry context, and therefore the business which is operating. You marry that then to the growth. You're looking at the runway for growth, you're looking at the capital consumption for growth, and the growth of the cash flows in themselves. You have to, and each of these are dynamic variables. Pinning each of them is difficult. It's valuations and analysis can tend to be a bit of an art, can be a bit of a imagination game as well. You have to exercise a bit of creativity around this. It cannot be a cold, rational, assessment. There has to be a bit of creativity to looking at companies as well. So once you look at growth and understand the kind of capital which is required, you can then arrive at an assessment of what your valuation of the company is and what are you willing to pay to buy that particular company. Now this is not a static assessment. Business models evolve, companies evolve, growth runways evolve, assessments of growth evolve. That is part of the reason why stocks move around so much. It is a live voting machine in a sense on these various parameters. The market is continuously assessing all these parameters on a dynamic basis, and you as a market participant have a choice to agree, disagree with the stock price which is reflected. But at the heart of it, you need to make your assessment of all these parameters first.
Okay, so do you believe in actively churning the portfolio? Because nowadays there's a lot of AMCs in a call, be it, everybody is adapting that particular strategy about having a higher portfolio turnover ratio. Do you, and there are a lot of fund managers who still believe in sticking on to their winners, focusing on that particular stocks and going for a longer run rather than actively churning their portfolio. Which side would you be on?
Our portfolios tend to be skewed towards consistent compounders.
Okay.
So maybe 2/3 of our portfolios, our large portfolios at least, tend to be focused on this side of the market. So we are looking at long-term winners. We will not, however, look to just hold on to our winners. Right? So going back to what Howard Marks had said about, there's no asset or a stock which is so great that it does not become a bad investment at a certain price. We are also very valuation aware. We marry that line of thinking and say that at a particular price, irrespective of how good the quality is, how good the organization is, how great the management vision is, it can become a bad investment at a particular price. So that's where we tend to be live on in terms of our assessment of the investments. Now there's a nuance here, that we will look to give managements of high quality a longer rope.
Okay.
standing outside the market or standing outside the company, we can make assessments about what a company can deliver. We can look for adjacencies. But high quality management, high quality managements have shown the ability to identify opportunities, adjacencies, acquisitions, which are highly value accretive, which we could never have fathomed. And then you can tend to underestimate the growth which is actually can be delivered or which has been delivered by the company. So we do tend to distinguish between companies and managements and industries which have the potential for showing high quality versus those of maybe lesser quality. So that's one place where we will tend to make a bit of a adjustment.
So how do you feel about missed opportunities? Now everybody is talking about FOMO, or fear of missing out. So, and how do you feel about missed opportunities? You couldn't get onto the rally, you missed out on that rally, or how do you feel about it? And do you think you would like to enter that particular stock in the longer run, or what is your view on that, missing out on particular rallies or say opportunities?
Every day is a fresh day. Every day is a fresh day, right? So you go into work, it's a fresh day, fresh opportunity for you to assess that stock.
Okay.
That is true for your entire portfolio. So not just your winners, not just your losers. Every day is a fresh day to assess your stocks which you're holding or not holding and arrive at a conclusion on them. And so if you have missed out, the question is not, well, the stock is run 100%, or the stock is run 50%. Standing today, what has changed in the company from your earlier assessment? And does that change now warrant an upside from here? That's all that matters.
Okay.
Make that assessment based on all the parameters which we have spoken about and take a call today. The past is almost irrelevant in that context.
Okay. So I've heard you talk about a lot of famous investors like Peter Lynch, Howard Marks just now. Even we were doing our research on the memos. Even we try to go through the memos, even though it's a bit harder to digest. In a similar way, do you think, do you have a favorite fund manager or an investor, Indian investor?
Well, there are a whole lot of them. I think even in Franklin Templeton, I've worked with the entire senior management team, senior investing team. When I joined, of course, Shiva was part of the fund management team. Along with that, Sukumar is also, he's still a part of the organization. Janki, of course, our CIO, Anand, our previous CIO. These are, if you look at the kind of results which our funds, the Franklin Templeton funds have delivered over the long period of time. We just completed 30 years of the Franklin India Blue Chip and Prima funds. They have delivered something like 200x returns over 30 years, 19 to 20% compounded a year.
Yeah, that's great.
This cannot be done. I mean, the reason this has happened is that these people were at the helm of these funds at this point during this period of time. So there's been always a lot to learn by speaking to them, and I continue to learn a lot from them.
Okay. I would like to know more about your core investment philosophy and how it helps you outperform the markets. Do you have any particular investment strategy, be it growth investing, value investing, contra investing, or do you have any such particular favorite strategies?
So at FT we have this acronym called QGSV. So it's quality, growth, sustainability and valuations.
Okay.
We start off with assessment of management, right? So a broad brush understanding of what has been the track record of the management. What is the past decisions which have been taken to grow the company? How has the company grown? And what has the management done not just to this company maybe, but other companies in the past? Okay. What has their track record been of creating shareholders? Are they aligned with shareholders? Are they looking to create long-term shareholder value? So what are the measures which have been taken? So quality has to start off by assessing these parameters, but also you're looking at quality from the perspective of the profitability of the companies. At the heart of our investment decisions, though, tends to be growth. India is a growth market. The reason we are looking to invest in opportunities here is growth. We are looking at the India growth story is what excites all of us. So growth and the assessment of growth is something which we are continuously looking out for. Along with that, sustainability of the growth. sustainability of the growth runway, and the measures taken by the company and the management to ensure the long-term viability of this growth is important to look at. At the same time, we are valuation aware. We will not buy a stock just because it looks good in any way. We will look at the price at which we are buying these stocks as well. So that summarizes the full investment approaches we take at FT.
So I want to know about your current views on the markets. So I'm hearing a lot of noise, a lot of news saying that the markets are going to go on a sideways for the next coming 6 months, or maybe the next opportunity where we can end up would be the interest rate cuts. What's your take on that?
We focus on the corporate earnings. It gets back to that. How much are corporate earnings growing, and how much are stock markets moving? If you look at the last 5 years, at least the large caps, it's the Nifty 50 companies, or the Nifty 50 index has doubled the earnings. During this period, over the last 5 years, say from 2019, Nifty has doubled as well. So the bedrock of this rally, this stock market rally, has been corporate earnings. Mid and small caps as well, they've grown faster than the large caps. They started off on a depressed valuation in 2019. If you remember that 2018, 2019 were bad years for the mid and small cap space. They start off at a low valuation. On that, they have seen excellent growth. So we continue to focus on that. Having said that, we think that, well, yes, markets have seen a bit of a run up in the recent past. A bit of a consolidation here would be healthy for the markets. So, but having said that, as long as earnings are coming through. So, for example, if you look at earnings coming through, I'd say 14% per year next year. If that comes through, then if markets stay sideways for say 6 months, then you are looking at a 7% correction in the valuations. So that's the way we try to think about aggregate market valuations. Having said this, on a bottom-up level, we continue to find opportunities to invest. There are pockets in the market where we are able to find opportunities, and we continue to add them to our portfolio.
A follow-up question to that. So, when we're looking at an investor, retail investor, or an investor's perspective, how do you think the fund deployment strategy should be at this market levels or valuations?
Sure. So if investor is not invested in the Indian markets right now, then the best time to invest is now. I mean, best time should have been before.
Yesterday.
Or 10 years back. But
next
best time is today, exactly. So I think at least 50% of your investments you can start by deploying today, and you can look at a staggered investment approach in coming years as well. So it's important to have some investment in the market at any point of time, right? So I think even right now, it is good to take an exposure to the markets, get onto that, and keep adding to the markets going forward as well.
Okay, got it. So I've heard a lot of interviews where you talk about active and passive funds. So that's my next question.
Sure.
So what's your take on active versus passive? Who do you think is going to win the argument, active or passive? And what is if I'm adding a passive fund or an active fund to the portfolio, what do you think the percentage allocation should be approximately?
So the Indian markets are still geared for a lot of growth on the active side. That is eventually what my conclusion has been, and that's why we are here talking about this right now. So the active funds across the board, if you look across various pockets of the market, they continue to hold a high level of relevance. Indian markets still tend to be fairly inefficient in terms of the number of eyeballs even looking at the stocks. So the top 100 stocks have maybe about 30 analysts who are publishing results on Bloomberg, for example. And that's a high level. But if you go to the small caps, you'll get many stocks which are uncovered, which are not covered rather. So there are opportunities to invest as you go down the curve for sure. Definitely on the large cap side, there is more of this debate. But even within that, a fund manager who is looking to manage the fund in an active fund, in an active fashion, genuinely active fashion, not looking to just closet index. If you look to just closet index, then you tend to end up with a point where you can have your returns not being adequate enough to cover your costs. That's the heart of the passive argument. But if you are managing it genuinely actively, then there's still opportunities to generate alpha in the Indian markets. So the reason why you may look to add a passive fund or a passive index is that you are comfortable with getting that index rate of return. Active funds offer the possibility of earning more with appropriate fund management, and you can find it with where there are places where the fund management teams have a long track record and deliver track record of doing this. Then you can definitely look to partner with them instead.
Also, what's your views on the US markets at the current valuation?
The US markets are very interesting because if you look at the last year, it's been a very concentrated market.
Yeah.
So S&P 6 is different from the state of the S&P 494. Right? S&P 6, the top 6 markets have been very concentrated in terms of the performance. So if those stocks in aggregate have more than doubled, then the rest of the market has done nothing. So to a certain extent, one argument can therefore be that the rest of the market, if AI as a theme had not picked up, the US markets would have gone sideways. Having said that, therefore, the 494 have gone through a period of consolidation. Earnings have not done too much there as well. As discretionary spending has been put on hold on the corporate side. There was a fear of recession as the interest rates spiked. Now the recession fears seem to be tapering away. With that perspective, then we are calling for definitely a period of some level of consolidation at FT. A recent poll of CIOs, global CIOs, showed that we are looking at markets staying sideways through till the end of this year. So that's an overall picture which we are looking at, and the market therefore could become a bit more broad as well. So while the top 6 companies have done well so far, and we are very optimistic on the AI theme, that performance could now spill over to the rest of the companies as well.
Okay. So how do you manage risk in your portfolio during high volatility times? For example, very recently we had a one-day fall that was the biggest in the last 4 years. So how do you manage risk at these volatile times?
Risk management cannot be a function of just the volatile times.
Okay.
It's a process. It's an ongoing day-to-day live process which we have. If we are looking to wait for the volatile times to manage the risk, we are too late.
Okay.
So it's something which we've always had as core part of our investment philosophy. We have I think there's been heightened risk focus on the small and mid cap space.
Okay.
Where additional disclosures have been asked to be made. But some of those practices we have already had in-house forever.
Okay.
We have looked at concentration of our funds or liquidation times for our funds. We have always looked at that. I mean, our risk management teams have always been on top of some of those parameters. Not new to us, and we've always believed that this is something which we cannot wait for the last minute to manage the risk.
Correct.
It has to be done ahead of the curve and continuously.
Okay. Also, earlier you were working as a CEO of now BAMC. So how was the transition from a CEO to an institutional portfolio manager being?
Sure. So it's worthwhile explaining a bit about the institutional portfolio manager or the client portfolio manager role. This role seeks to bridge the fund management team with external partners.
Okay.
The idea is that the Indian fund management and mutual fund industry has been evolving. It has become a lot more sophisticated. There is a lot more interest in understanding what funds are doing. Why are funds performing the way they are? So it's no longer the case that you can just look at the performance and be happy with that. You've got to understand why it's happening. And always at the heart of any of these questions is this performance sustainable?
Yeah.
So to understand that, my role is I'm a part of the fund management team. I work alongside them And at the same time, I'm spending more time on the road, meeting our esteemed partners, and communicating what our fund management team is thinking about our funds, about the markets as well.
Okay, got it.
So just to, from going from the CEO, I understand, the business side of the mutual funds, and with my past in fund management as well, I understand that side of the business as well. This role seeks to marry both.
Great. So I would like to ask my last question. Would you mind disclosing your current personal portfolio allocation, and how often do you rebalance your personal portfolio?
So my personal portfolio, I would be looking to have currently about maybe 65 to 70% equities,
Okay.
5 to 10% commodities. This is excluding real estate for living in. So 65 to 70% equities, 5 to 10% commodities, rest in debt. There's always a bit of cash I try to keep it's more a behavioral tool. So that's my hack on behavior. So when markets tend to be a bit volatile, I like to have something to participate in that.
So how much percentage do you keep as cash?
It's about 5%, 5 to 10%. So it's more a behavioral tool. Of course, I'm continuously deploying in the markets on a monthly basis. But this is just a bit of a behavioral hack as well.
So what about the crypto space? Now I've heard that in the last 5 years, crypto went up by 500%.
I'm sure. I'm sure it fell by equal amount as well. So I have, virtually nothing in crypto. I had taken a little bit just to be on top of what's happening, but not as an investment opportunity. See, the problem for me on that side is that I don't have a good way to explain why it's going up, why it is falling. So the reason why you would hold an investment is that you get conviction when it falls, or you understand why it's fallen. When Bitcoin falls from 60,000 to 20,000, I don't know whether 20,000 is fair or was 30,000 fair, is 70,000 fair. So I don't. So that tends to be the dilemma for me. So if I don't understand it, it's not an investment tool for me.
Makes sense. Thank you so much for your time, Mr. Hari.
Thank you.
It was a pleasure.
Thank you. Great to be here.